how to identify the market top. Now, this is the market top in all markets. We're talking about the market top in all markets and in all time frames. One of the major keys to market mastery is being able to identify when a market has topped. But not only when it is obvious that it has topped. One of the very great master keys or major keys to market mastery is being able to identify when a market is about to top. We're going to go over specific characteristics that are going to help you be able to know almost in advance when a market is likely to top. And I'm going to teach you how to nail it virtually every single time. The players that really do super well in the market, they know how to identify tops. They know how to sidestep them. And more importantly, they know how to turn market tops into fast, powerful profits. Profits are faster and they're bigger and they're harder for market tops. And this is why traders who have the ability to identify market tops, they tend to be the more profitable traders overall. The 4 characteristics of market tops. Number 1, a major market top is usually preceded by very dynamic 3 to 5 leg runs. Now, I'm going to show you what this means. In essence, a stock can run from a low point to a high point, but it will do so in segments. So it might run up, pause, run up again, drop a little bit, and then run up again. All of these are individual legs. Leg 1, pause, leg 2, pullback, leg 3. But this is an entire run to the upside. But every run to the upside is really comprised what I would call different legs or segments. And you have to be able to read the segments and know where you are in the dynamic run to the upside, because statistically speaking, runs that lead to major tops, they happen over a 3 to 5 leg run. And a trader who does not understand that tops come between 3 and 5 legs, they often get caught at the top buying leg 4 or buying into a leg 5. So if a stock runs up over several legs here and a trader's going to buy this leg when it is leg 1, leg 2, leg 3, leg 4, not knowing that there's a lot smaller upside from here than there is downside to go, because you're already buying into a very mature multi-leg run to the upside. The best odds for maximum profitability, guys, is when you are buying leg into a leg 1 or leg 2 move to the upside. You're riding leg 3, you ride leg 3, you start taking profits in leg 4 and leg 5. These are your profit legs. But if you don't know how to read a market's legs, how do you know where you are in that market's dynamic run-up? We buy legs 1 and 2, we ride leg 3, we take profits on legs 4 and 5. Look at my face here. 3 to 5 legs up. We buy leg 1, so we buy legs 2s. You got to know how to read what's leg 1, what's leg 2. You ride leg 3, relax. Don't tinker, don't touch leg 3. You take profits on leg 4, leg 5. Leg 4 and 5 are not entry legs. They're profit-taking legs. Characteristic number 2, near vertical acceleration toward the end. So if you got this multi-leg run-up, 1, 2, 3, if this leg is the most vertical of all the other legs, here's leg 1, here's leg 2, here's leg 3, and leg 4 winds up being the most vertical, that's high odds that that's the final leg. If the most recent run-up after a pause, after a rest, because pauses and rests, they separate the legs, right? This one is the most vertical. That's the one that's going to be the top most of the time. The most vertical leg is mostly the top. I'm going to repeat that again. The most vertical leg of them all is usually the top one. You've got the top. So 3 to 5 leg run up, near vertical acceleration, that's usually your final leg. If I were to isolate the run up in leg 4, this run up is made up of multiple bars. So that fourth leg could look something like this. Boom, 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 and boom. So I'm saying that could be that leg right there. Oftentimes, the final bar of this multiple bar leg run up is the biggest one of them all. When you've got that scenario, you've got vertical run up, and the last bar of the vertical run up is the biggest bar of the entire run up. You've got your top, baby. You got your top. You're at or near it. We call this an exhaustion elephant bar. It's exhaustive in nature. The bulls are shooting all the bullets they have at the market, and they've just emptied the clip. They've emptied the gun. There's no more bullets left. There's no more buying power left. They put it all in that last bar. So that's the third characteristic. So remember, we got 3 to 5 legs up. You're likely near a top. If the last leg is near vertical acceleration, you're very likely near the top. And if the final bar of that near vertical acceleration is the biggest bar of that last leg, you're almost certain that you're at or near the top. And the last characteristic is what I call the 3-finger spread. I have spoken about this before, or what I call dual space. Here's what's important to understand with these 4 characteristics. You don't need them all. You can really just have one of them. Oftentimes, they are stacked. You may not get all 4. There are times you'll get all 4, but you may not get all 4. You only need one, but oftentimes, you'll get 2 or 3 of these stacked at the same time. I have rarely in my whole career seen a major top in any stock, any market, any index, it doesn't matter, that did not have at least 2 of these. I can probably count on one hand in 44 years. These 4 characteristics usually come in pairs. You usually get 2, sometimes 3, and every now and then you'll get all 4 of these, and you're like, whoa, all 4? You better watch out below. Here is the 3 to 5 leg plus vertical blow off image. I'm showing you 2 of the 4. Remember, characteristic number 1 is the 3 to 5 legs. Now, legs are usually fluid runs that are interrupted by a pause of some type. Sometimes that pause can just be sideways movement, and boom, you're off to the next leg. Sometimes that pause can be a mild pullback, and then boom, you're off to the next leg. Sometimes that pause can be very brief, just in a little stutter, a little flickering, which I demonstrate with a circle, and boom, you're off to another leg. There are separators. These are separators between legs. You see, this is a separator between legs. This pullback is a separator between legs. They're really pauses on the way to the upside. If you know how to read the pauses, then you automatically can see that there's leg 1, pause, leg 2, another pause, leg 3, another brief pause, and you're into leg 4. So you're already in the zone of 3 to 5, which is characteristic number 1. This means that you're in a mature up move. It's not fresh. It's not new. In addition to you being in the range of 3 to 5 legs to the upside, you've got the second quality, which is the last leg is the most vertical one. So this was a nice angle to the upside. 2 was a nice angle to the upside. 3 was a nice, but 4, I tried to show you, is more vertical. That increases the odds that you are at or near the top. If the last leg is more vertical than all the other legs, jump the odds that you're at or near the top in a very big way, right? So these are 2, the 3 to 5 leg run up plus vertical blow off move. The third characteristic is that out of this last run up, the most recent bar is the biggest bar of the entire run. So not only is leg 4 the most vertical, inside of that vertical run up, the most recent bar is the biggest one of all. Now, guys, when you get the last bar of the vertical last leg, if that's not only the biggest bar of the last leg, but it's the biggest bar that ever occurred during the whole run up, OMG. You're talking about the mega top of all mega tops. You've got the most vertical leg of them all. Inside of the vertical leg, you've got the last bar is the biggest bar of that leg, but you look and see it's not only the last biggest bar of that leg, it's the biggest bar of the whole freaking run up. Do you know how many traders are trapped and piled into that bar? And that creates a top heavy market. You understand? You understand what a top heavy market is? That most people are committed at the top, which means that they're vulnerable to a move to the downside and will start bailing ship at a heartbeat. It's powerful when you have this deeper reading ability, this deeper ability to almost see inside of the market and to know what's going on, to give you that refined feel with these characteristics. And I know when most traders are trapped at the top. These are the characteristics that let me know that. And I know they're susceptible to move to the downside now. It's taking your analytical skills to a very, very high level. There are not many people walking around in the markets today that have this ability to read like this. So we've got the 3 to 5 legs, characteristic number 1, characteristic number 2, all right? The last leg is the most vertical. That's characteristic number 2. Characteristic number 3, the last bar in that leg is the biggest bar. That's characteristic number 3. And characteristic number 4 is the 3-finger spread, or what I often call sometimes dual space. So what is this? This involves the 20-period moving average and the 200-period moving average of your item. Now, when your stock leaves the moving average in the dust, so when it starts to just skyrocket away from the nearest one of these two, you create what I call the 3-finger spread. Your stock is way above the 20-period moving average. Your 20-period moving average is separated and well above the 200, creating dual space between the 3 items. This space tells you there's a lot of room to fall. And guys, the reason why I call it the 3-finger spread, because I tell traders, look, just spread these 3 fingers out as wide as possible. Your stock, your 20, your 200. When you've got that wide spread, that stock or whatever you're looking at is very vulnerable. It's on thin ice up there, and any crack will cause an avalanche of traders to just leave the stock, accelerating the move to the downside. Now, there's reasons why this makes the stock vulnerable. I want you to think about how many people are holding profits. Think about this, traders. Let's remember, you're not trading stocks, you're trading people. So stocks don't move unless people act. It's really the actions of the people that are moving the stock, right? So in essence, it's a psychological game. It's playing the mindset of your players. Now, if a stock has had 3, 4, 5 legs up, there's a lot of people holding profits. If you get way above those moving average, there's a lot of people who's got hefty, unrealized gains. That last big bar exploded their profitability. And now their profits are so fat, so big, that they want to protect them. So any amount of red freaks them out. Uh-oh, wait a minute. I'm getting out. I'm cutting half of my position. I'm doing that. And It causes an avalanche. Somebody yells, fire in the theater, and all the traders start rushing to the exit sign, trying to get out of the theater before it completely burns up their profits. So when you can technically read this point where you know the stock is on thin ice now, it's very susceptible to profit taking. One little spook, one little scare, one solid red bar is going to send everybody from up here in Pluto with the 3-finger spread. It's going to send everybody running for the exit signs. Tell me if you understand the psychological part of this picture and why it typically leads to violent drops to the downside. When you understand it from the people side, it's better. You don't have to understand it from, well, the company's products are not that good anymore. That's why it's going to go down. What? The PE ratio was too high. Isn't that why it's going to come down? No. If you read it from the people side, do you understand? Look at this 4-leg run-up and the violence of the last leg. They're holding huge profits here. They're going to be taking those profits soon, and any scare is going to send this stock reeling. That's the proper view, not the PE ratio, Oliver. It's crazy. Unreal. The PE ratio. How to survive chaotic pullbacks. I'm first teaching you how to identify high odds market tops before they actually drop. How do I know if from that top, this is just another pullback that will lead to a continuation, or is it the actual final one drop? What I'm taking you to the next step now, how to identify a pullback versus a collapse from a top. A collapse from a top is not a pullback. A pullback is buyable. A collapse from the top is not buyable. So you need to know the difference and how to read the difference. That's what we're going to go over next. Not only how to survive chaotic pullbacks, but I want you to know how to profit from them as well. In order to do this, I'm going to have to teach you my personal, basic, but very powerful trading division. And I use this concept, I call it 1/2 and thirds. So what I'm diagramming here is a strong run up in the stock. Now, that's not one bar. That's a multiple bar run to the upside in your stock or your underlying item, right? And I want you to note that, okay, it tops and it starts to pull back. Now, what you need to do is you need to divide the run up in half. So from start to finish, where did this run up start from? Started here. Where did it peak from? Temporarily, at least. It peaked there. Now, divide it in half. Just draw a line straight in the middle, just like I did here. You got to split that entire run up. Find the halfway mark. Guys, I don't want you going out to your local convenience store and getting rulers and, right angles and geometric tools. Oliver, is this halfway? Like it's a general thing. You don't have to be very, very precise. Just cut the thing in half. Like you would a banana. Boom. Okay, that's the halfway mark. You're not measuring it and trying to get it so perfect, okay? What we're also going to do is cut it in thirds. Now, what this is going to do is give this entire run-up 4 zones. Now, I'm going to show you the 4 zones. I know you see them, but the top third zone, you've got this next zone, you've got this next zone, and you've got the bottom zone. So coming on the way down, you got zone 1, you got zone 2, you got zone 3, and you've got zone 4. So you have to be able to know how to zone out your run-ups and your rundowns. Everything is applicable in reverse. But we're talking about the run-ups now. Here's the key. When your stock stays in the top third, you've got 80% odds of a new high. So we're dropping like this, you're dropping, but you turn, boom, without severely violating that top third. That's 80% odds you're going higher and you're going higher by a decent amount, not just a peekaboo high. You're going to shoot way past that high. So let's get these odds straight. The pullback stays in the top third of the entire last run-up. You're going higher, buddy. Now, I call this a color change, right? Right? I've gone over this many times in my videos. This is a color change. Red, red, red. And then all of a sudden, boom, green reverses everything. Boom. Right there, that's your color change. We're looking for a color change in the top third to get that 80% odds we're going to new highs by a decent amount. If your color change happens in the top half, your odds drop to 65%, still good odds. But you go from 80% to 65% that you're going to move to a new high. Still better than flipping a coin. Still profitable. Guys, remember what 65% means. It means that 6.5 times out of every 10 you win, which means that in order to get 6.5, sometimes you get to a new high 9 times out of every 10. Sometimes you get to a new high 8 times out of every 10, 7 times, sometimes 4 times, sometimes 5 times, but it averages 6.5 times out of every 10. You're going to a new high as long as you get that color change. Remember what a color change is, guys. Red, 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 then green reverses the red. Boom. That's your color change. This is your color change. Green takes out red. So if you get this in the top half, you're dealing with 65% odds of a new high. If you get this in the top third, you're dealing with 80% odds that you're moving to a significant new high. How many people, guys, know these odds, know these stats? How many people have this so precise this way? Very few. Most people are out there guessing, rolling dice, rolling bones, calling up the psychic hotline, checking up on other losers in Facebook chat rooms and stuff like that. Not you. You're playing by the numbers. You're playing by specific, precise concepts and strategies. If your pullback falls to within the second, third zone, remember these zones, your odds drop to 35% of a new high. So now we're going into the other way. It's better not to bank on a new high if your pullback is this deep into the last run-up. See, this is your last run-up. This deep into the last run-up, the bounce is probably not going to make the new high. That's what the odds suggest. And if you drop to the last part, remember these 4 parts, right? Your odds are 15% that you bounce all the way back to a new high. That's almost saying it ain't happening, bro. Do you have these odds? Talk to me. I need somebody to talk to me. You have these odds. 80%, top third. 65%, pull back to the half, around halfway or less. 35%, you break the half. 15%, you break the bottom third. Tell me you've got this. Nice. I can feel your intelligence rising rapidly. I can feel it. I can feel it going higher and higher and higher. Your understanding. Wait till we look at examples here. Oof, it's coming. I'm going to show you. I told you I'm going to blow your mind with this. All right. The pullback versus the collapse. If you just get this down right now, what I'm about to cover for you, if you can just get this, this is going to take you to a different stratosphere. Just this one thing, because most trouble in the market, not knowing if this pullback is a buy or should I run for the hills. I'm telling you, like 70% of all problems, all lost money in investment world, in the swing trading world, in the day trading world, is not knowing how to read the difference. Not knowing whether this is a gift. This drop, is it a gift? Or should I be running for the hills? Or should I be betting the other way? If you can just get this, you're going to go to a completely different galaxy in your trading. Promise you. Probably the most important thing I'm going to explain to you here today. Let's go. Pullbacks versus collapses. The healthy pullback, the gift. the one that you should be thinking about buying. Here are the characteristics. Number one, first of all, I want you to know we're talking about after a nice, strong run up in your stock or your underlying item. Okay, nice, strong run up. Remember, you're supposed to always cut it in half and thirds. Don't forget that. Everything is going to come from you knowing the area of the half and thirds, knowing the 4 zones. Your pullback into these zones, if it is more of a drift, it's healthy. So look what I'm saying, a 45-degree angle drift. Now, the way I explain it to my trading kids is this. I draw a little mountain and I draw a little hang glider here. He wants to hang glide off this mountain into the meadow, but he wants to jump off the mountain and glide down the mountain. You see? Gracefully, smoothly. But you see, he doesn't want to trip and fall straight down. Your pullbacks that are healthy, they drift down the mountain. They don't starkly trip and fall straight down from the mountaintop. There's a difference between a drift and a trip or a collapse. If this drift remains anywhere above the halfway mark, you're good. So what are you buying here or there? You're buying the color change. You're buying the first time a red bar gets taken out by a green bar. Boom, right there. There's your buy, right above the high. Boom. That's what you want to see here or there. But only if you have the 45 or so degree angle drift. The color changes don't count if it's a collapse. Now, the last thing I want to point out to you, there's usually no violent elongated bars in your drop, especially the first one. Let's say you have this run up and you get something like this. Boom. That is too violent of a first bar drop. Usually your color change here that might happen will fail. It'll trick you into it. Why? Because this is too violent. It's too powerful. It had too much velocity. I don't want to see that in a pullback. To me, that's a collapse. That's not gracefully coming off this mountaintop. So no violence to speak of, and no breaking the half, and 45-degree angle drift. No vertical drops. And that's when you know that this pullback is a gift. It is not a reason to be concerned. It is not a reason to run for the hills. It's not a reason to be nervous. It's a reason to add. The $64,000 question on Wall Street is always, is this the top? Does this pullback mean that we've topped? Or is this a buying opportunity? That's it. Every financial show on CNBC, Bloomberg, it's the same question. Are we near the top? Have we topped out? Is this pullback just healthy? Is it normal? Is it a gift? Is it a buying opportunity? They have entire financial shows around this one question. And I'm giving you the keys to being an expert on those shows, being an expert in your play, how to identify collapses that you should be concerned about versus gifts that you should be trying to find more capital to put into the play. Now, the collapse. Elongated vertical drop. This is not a hang glider gracefully coming off the mountaintop. Nope, that's tripping off the mountaintop. Something wrong happened there. He didn't gracefully come down. He tripped and fell. Even if, guys, you get the color change here, don't fall for it. Do not fall for it. Do not fall for it. The drop was too vertical. It was too elongated, too violent, too much sudden, powerful, abrupt momentum to the downside. What you must understand is that pullbacks are just pit stops. They are rests. Your athlete can't run without having some type of rest between races. Each leg is a race. And so it pulls back to rest, to get rejuvenated, refreshed. In NASCAR, they don't keep running around and never have a pit stop. They get a pit stop. It's for a couple of seconds, of course, but it's still a pit stop. It's still a rest. It's still a refresher. And then they're right back on the racetrack. These pit stops, these rests are healthy. They allow your stock to refuel and go higher. But there are some drops that are not rests. They're warning shots. They're signs you better get the heck out of Dodge. They're signs of dumping. They're signs of institutions leaving the stock right now. So understanding this difference and knowing how to play them both just takes you to a completely different level in your knowledge, in your level of sophistication, in your entire market play. Let's talk about my famous crash play. And I think after this, we start looking at some examples. It involves a violent bar crash, elongated, powerful, bigger than normal. What does that mean? I can't give you a specific number as terms of size. All I can just say is look to the left. And if this bar is bigger by orders of magnitude than all of your recent bars to the left of it, here are your recent bars to the left. Now, look at the size of this one versus the average size of these. That's a crash bar. So crash bars are elongated, powerful, violent. They have a velocity that is through the roof. These crash bars, they can come from a top. So you can get something like this. Let me show you. You can get something like this and boom. Now here's your crash bar. Boom, right? So you get a crash bar from the top. You can actually get a crash bar from a gap. So let's say your stock was trading here yesterday, and this morning, the stock, let's say it ended here yesterday, and the following morning, your stock opens here on a gap and crashes right into support, but it's still a crash bar. You can get a crash bar from the 200. So there are a variety of scenarios where this violent bar crash play can materialize, and they're all profitable, all of them. Some people will say, well, Oliver, if it crashes to the 200, isn't that in the buy area? No, not if it's a crash bar. The crash bar cracks the 200 significance. Sort of like this was ice, so the 200 was ice, right? Was a frozen lake. But this crashed so hard into the frozen lake that it cracked the ice. And now, any bounce is a sucker's play. Boom!
Hi, traders. Colombian coffee, the best, the best. Listen, I have something that I want to speak to you about. Come with me. Traders, my Bitcoiners, my team has recently brought something to my attention that actually blew me away. My team told me, hey, Princesa. My team told me that a very small percentage of you who come to my YouTube channels every single day to watch my content are actually subscribed. That a very minute percentage of you who are dedicated enough to take in the content every single day, that a very small percentage of you actually have taken the step to subscribe. Now, I want to explain something to you. My team and I, we spend a great deal of time every single day, hours, making sure that you, each and every day, receive something of extraordinary value, something that, in my opinion, will raise your level of market sophistication and will increase the odds that you take an additional step every single day toward that ultimate goal of trading mastery, the thing that we are all striving for every single day. Now, subscribing to the channels is absolutely free to you. It costs you nothing. But at the same time, it's very valuable to us people, traders. It's valuable because it helps the algorithm help my powerful content and education get out there to more people who truly have a passion for this wonderful activity we call trading. And all you have to do is click subscribe. It would mean the world to me. It would also mean the world to me if you even went the extra mile by clicking the bell in the upper right-hand corner to ensure that you never miss a single piece of content. Do this for me, traders. Do this. It would mean the world for me. In the meantime, trade well, and I will see you in the next video. Boom, boom, boom. Ciao for now, traders. Love you to death.
So what do I mean? Remember I told you that there are legs to a run, right? So that's a leg. And if it starts doing this, remember what you're supposed to do with your leg. You're supposed to cut it in half and thirds. If your item has run up and it stays in the top third, remember what the odds are? 80% you're going higher. Remember that? That's one of the slides of the presentation. If you go down here, you're 65% going to a new high. Remember those odds. Bitcoin does a lot of one-thirding. It does halves too, but it does a lot of one-thirding in the bull run. So let me show you. Let's look at the one-thirds, all the one-thirds. This is just from April. So we run up, and then it one-thirds on you, right? So that's leg one right there. Then you run up, and you one-third. It just doesn't come back to the halfway mark often. And you run up again, and you one-third it. It does a lot of one-thirding. So now it gets into this pretty predictable trading range here. And then right when it has this 20 MA halt play here, it starts one-thirding again. Run up, now it's one-thirding again. You see? And see how you can read the legs? What's the odds of a new high? Tell me, what's the odds that we go now into the 120s toward the 130s? So I wanted to show you the one-third concept. On Apple here, guys, take a look. Take a look at the left-hand side of the chart. I want you to grab the beginning of the move. I want you to grab the top of the move. Now, sometimes it's very subjective, guys. Reading the different legs, you know? It can be subjective. I get it. You get good at it, though. You get good at it. All right? So you're really concentrating more on either fluttering around, doing nothing is a separator. Pulling back is a separator. So that's a separator. Fluttering around in a sloppy way is a separator. Even a brief little 1 or 2 red bar thing here like that is a separator. It takes a while, but it starts to get clear what are separators. Boom, separator. Boom, separator. Boom. So you've got multiple legs here on the run up. 1, 2, 3, 4. You're mature. All right. We don't have the characteristic of the fourth leg being vertical. We don't have that. Remember, you don't need all of them, but we do have the 3 to 4 legs up. We've got the 3 fingers spread, and we have, boom. I'm taking that as a bar that's elongated and powerful enough to where if I were to split this in half in thirds, you see how it bounces up right there and then collapses again. Now, my traders know I would be shorting up here. But what I really want to also show you is I'm showing you how to do it with a bar, a single bar, where you take a single bar that's powerful and you split it in half and thirds. You know that the bounce is a sucker play. So the people who think that you're bouncing back from here and buying that, they get suckered in. But also, I want you to be able to do this on a full run. You see, that's a full run. Now, I want you to look at this like one move, and I want you to split this too, half and thirds, so that your macro sucker play can be played. So this is the micro sucker play. Drop, sucker play, drop. But this one is the macro. Drop, half, and thirds. Sucker play, drop. Do you understand the micro and the macro? Let me know if you understand. Micro is the one bar attempt to move up and boom. That's the micro. The macro is the full move. Drop, you look at the full move as like it's one bar, then you split that in half and thirds so that the multiple bar sucker play bounce, boom, you know how to profit from that too. So my traders know to grab the micro and the macro one. I want to make sure you understand this. I just want to see your comments. Do you understand the difference between the macro and the micro? Let's continue. Let's continue looking at these examples here. So guys, you got your micro bounce here into the collapse bar. You've got your macro bounce here. Remember, you're waiting for a color change. Red eliminates green, eliminates this green one right there. Look at this violet bar, half, thirds. You kind of come right up to the third sucker play. Boom! It's crazy. I do a lot of these crash plays, guys, a lot of them. Now, I want you to take a look at Tesla. A lot of my traders had this play. I want you to look at, this is the 25th, all right? This was the 24th. This is the start of the 25th. Now, I want you to look at the pullback here. Now, I told you that one of the keys to mastery is knowing, is the pullback in this play buyable? Is it a gift to add or initiate a play or get more, or is it a problematic drop? And I'm going to tell you that, remember the characteristics. If it's straight down like that, it's not. If it's a drift and it stays in the upper half, preferably the upper third, you're good. Now, some people say, well, Oliver, in this play, this drop, it's a 45-degree angle, but it's deep in the run-up. No, it's not, because I teach my traders, you must fill in the gap. When your stock gaps, I want you to fill in the gap and make that gap part of the move. You see, if the market were not closed, it would not have gapped, it would have traded there. So it's only gapping because the antiquated equity market is still closed. It's not 24 hours. So all of the built up demand over the night just gets immediately priced in at the open. But if the market was open, it would have traded there. So I want you to fill it in as if it's part of the move. Right from yesterday's close, fill it in as if it traded there. Now, take this whole move and split it in half and thirds. Voila! Color change, baby. But you got that? Fill in your gaps, guys. You got it? You got it? Fill in those gaps and then do your division. This is going to work like freaking magic for you. I promise you. The light with which you see everything now is going to be brighter with these concepts. You must keep coming back to this presentation as well so that you don't lose it. But I'm telling you guys, take you to a brand new galaxy. Now find the crash bar. What are you supposed to do with a crash bar? Divide it in half and thirds. Half and thirds. Now I want you to see the bounce. Look at the bounce, the next bar into the crash bar. So we bounce up because, guys, remember, this is not there. None of this is there yet. So what's happening here, guys, is that you've got the first bar as a crash bar. Now the next bar is moving up into my zones. So I got the first zone is achieved. The second zone is achieved. Now I'm shorting there. I'm more advanced, so I'm just going to short in those zones. I'm not waiting for anything. So I'm short. I'm coming in here. Boom. Boom. I'm shorting because what's the odds of it going all the way? 15%. I'm going to be right shorting in those zones 85% of the time. I'll have some stop outs every now and then, but not very often. Now, what you can do is you're supposed to wait for the green to disappear and then strike. So when does green disappear? It disappears now. Watch. Boom. Uh-oh. Most of the green is gone. Boom. All of the green is gone. Well, I did the wrong thing here. All of the green is gone right there. I don't know if you can see that. It was green first, but right here, I'm going to draw this line here. This was green. We were green first. Green, 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 green. And then the green disappeared. Boom. A lot of my traders strike right there. Bam. My green disappeared. Stop above the high. And the freaking rest is history. For me, this was like a $9,000 play. So crash play, bounce, drop. Some traders did another color. Some traders of mine did another color change here. Some of my traders said, well, Oliver, this is a crash bar too. We got 2 back-to-back crash bars. And look at the bounce, sucker bounce, and boom, back-to-back crash bars. Powerful. How do you know that this is likely the bottom? Oh, that should be simple. Your multiple legs down. I know this is from yesterday. 1, 2, 3, 3-finger spread. The move did start the day before. 1, 2, 3. Remember, it's 3 to 5 legs. So we've got 2 of the 4 criteria telling us this is likely the bottom, at least for now. Remember, it works the other way as well. Same thing, guys. Remember what I told you what to do with the gap. Fill the gap in, guys. Always fill your gaps in. All right? Fill them in as if it didn't gap there, that it traded there. Fill the gap in. That's your full move. I want you to look at the pauses. And guys, even this is a pause. It's a hidden pause. My traders know this is a hidden pause because you fell back so hard, that's still considered red. So it doesn't matter if you got that or not, but all you know is that there are multiple legs up, right? You got multiple legs up to the upside. 3 to 5 legs up with your separators. Do you have the 3-finger spread? Yes. Look at all that space between the 3 items. Tippy top of your stop, 2,200. 3-finger spread, you're wide apart. That's why I call it a 3-finger spread. What are you supposed to do when you have a full move and it starts to drop? What do? Go all the way, fill in the gap. You split it in half and thirds. If you try to profit on the downside on the first color change here, that's fine. But remember how many levels I told you to go for? Go for 2 levels. So level 1, level 2 inside of this. You understand? That's how we come up with targets. We go for level 1 and level 2. We don't count the top one. The top one is the entry level. And then you go for 1 level down, 2 levels down. And this trading by the numbers this way, guys, really makes your approach very systematic, far more precise. But if you wanted to short here, remember, you're shorting on from this 3-finger spread point. If you want to short, we don't get a violent bar up here, but we do get a color change where you can give it a shot. When does red truly take out a green bar and right in this area? Anywhere there is fine. Anywhere here is fine. 2 levels down. Boom, boom. Don't forget to do your trading division on everything, guys. Everything big, do the trading division. Look at Palantir on the 25th. Now look at the gap. See the gap? What are you supposed to do with that? Fill it in. Fill in your gaps, guys. Let's act like they really traded there. Now, look at that big giant run up. Split it in half, in thirds, and voila. Boom! 80% chance of a new high. The pullback stayed basically in the top third. This is going to have you seeing so many things much clearer. My traders know this is a clearing collapse play, right? So what is clearing? Let's say your stock is doing this. It's kind of in this range here. And then all of a sudden, a red bar just clears everything. Boom! It just breaks through everything. That's clearing. I want you to take a look at this. Look at the clearing. You see it? Then boom! Solid red just clears everything to the downside. Sucker bounce. You do get to the top third, but a sucker bounce here. You get the sucker bounce into the collapse. Color change right here. Boom. And traders can just keep doing the color changes if they're near something. Color change here. Boom. Color change. Boom. It just keeps going and going and going. This crash play and the sucker bounce is a huge moneymaker for us. All right. Coinbase. Remember I told you can crash into support too. Look at your support from the day before. But you gap and you crap out and collapse right into support. And you get that miniature sucker play bounce right here. Bounce, that's the micro version. And you drop to new lows. Now, these don't look like big drops, but these are big drops. That's like $5 drop right there. Even on a macro level, remember I told you, take your full moves down and also do your division. So here's the full move down. I'm drawing sloppy here, but you get the point. And even it couldn't even break any decent amount to the upside after a collapse like that. You have to remember, guys, there are people who bought here not knowing how to trade and play. And these people are left holding the bag and they're not happy. They're sad. And like they're stuck up here, sad. So they're instantly a loser. So any bounce, they're like, I got part of my profits back. And they just sell into the bounce to get at least some of their profits back. Boom. And that's why these crash plays work. You're getting a lot of pressure from people that are hurt from above. And the bounce is a gift for them to just get out. So they're applying a lot of get out pressure on the stock. That's why there's 15% odds of coming back. It's all about trading people, guys. All about trading people. This is another play, guys. I'll be honest with you. I got a tiny bit nervous with this one. I think this is the last one to show you. I got a tiny bit nervous with this, guys. Just a tiny bit. Because remember, when I get these hard drops like this, I split in half and thirds, and I'm already going to be shorting in these zones. Now, you're going to wait for the color change, but I don't wait for the color change. So this bounces and I start getting short more, and my stop is here. So I'm like, but now my orders are there in advance. I start to say like, wow, this is a strong bounce. It's trying to get into that upper portion. Then the collapse came. Love that sound. And then we took this color change. My traders can tell you. So this was more like the macro one. Drop, boom, profits. Then bounce. This is a sucker play too. Why is this a sucker play? Because remember, guys, don't forget the macro move down is the whole thing. And when you know how to divide, this is sucker two. Boom. This is the closest thing to kind of taking candy from a baby, guys, in the market. The bounces into crash drops. It's powerful. It's consistent. It's freaking highly profitable. Look at the crash play in hood. You gapped, you crashed into support. Now look at that 200 there. It tried to hold on, but the crash was so strong that the 200 is weakened. But look, more importantly, look at the sucker bounce into the crash. You see the sucker bounce? And the rest is history. It took a while, though. That 200 tried to hold on and eventually gave through because the ice was cracked by this. The ice was cracked. And each subsequent tap on the 200 just weakened it more. Boom, it just finally gave through. The ice finally gave through. And it all started from this sledgehammer coming into the ice. All right, guys, I told you we don't trade Bitcoin, but if I did, I would use the hourly chart. And you see all the concepts here. Leg up, stay in the top third, we're going higher. Leg up, stay in the top third, we're going higher. Leg up, stay in the top third, we're going higher. You see? Boom. 1, 2, 3, 4. You're pretty wide here. You need to rest. But now look, the macro move as well needs to be split. And we stay in the top third. do the macro rest. We're going higher. Now we get the full three-finger spread. And that's when you have to sell off. You didn't really quite get it here as dramatic as you would like. That's still more like parallel railroad tracks. But when you start to go vertical, you see, you started to go vertical here and into a three-finger spread. You just got to come down and rest. You have to. And that's exactly what happened. That these three concepts I shared with you today, they're going to pay dividends to you forever. They don't stop working. They're going to pay dividends forever for the rest of your living days as a market player. I have been using these for 3+ decades. They are just as reliable today as back in the 1990s, as back in the early 2000s. You don't have to be overly complex to really play the market successfully. In fact, the simpler your approach, the more powerful it is. Complexity weakens the power. I shared nothing that a 12-year-old can't identify and know. Anyone can do this. I know there's a high failure rate, but it's a high failure rate because of lack of knowledge, lack of understanding, lack of guidance, lack of the proper mentorship. I want to be that for you. And also lack of the proper amount of money. That's a big one. And so I try to help traders know the right thing. I try to transfer all of my knowledge to the traders and also give them the proper amount of capital to do it with and give them the constant day-to-day training every single day and have them grow every single day in knowledge, awareness, understanding, and have the right amount of capital at their disposal to take advantage of them so they're not risking their own family's money. No one on Wall Street does that. No one who gets hired out of school to go work for Goldman Sachs or JP Morgan or whatever on the trading desk, they're not trading their family's money. And this is a huge advantage they have. They're also under guidance. No one's saying, oh, here's $50 million. Go knock yourself out. They've got guidance. They've got a head trader overlooking them. They're being taught. They're not trading their own capital. Do you realize that you are better when it's not your money? Everyone is better when it's not their capital because you're held to a higher standard. You're more stupid with your money. You're more careless with your money. But if you know I'm watching, if you know Goldman Sachs is watching your performance, you're going to be on point. This is why billionaires form hedge funds, because they need the money? No, because they're even held to a higher standard. These billionaire hedge fund managers are held to a higher standard because other people's money is mixed in with their money. They're better. It's one of the secrets on Wall Street, guys.